Well, look, from our perspective, it's really these. I guess the key thing is about expectations for a soft landing, and with that, there's rising hopes that maybe, or rising concerns, in fact, that inflation could end up being stickier, leading to maybe further Fed hikes down the line. So not talking about in the immediate future, but further down the line, that maybe the Fed loses control of the inflation fight. And I've got to say, I do not buy into that. I think that we're going to see a drop in yields as you get closer to an economic slowdown. I think the inflation story will be, maybe it's not going to go back down to 2%, but it will be contained. So I think that this is actually an opportunity to add duration rather than being too concerned where exactly this is going to go.
So at the 10-year, at the 30-year, how long along the curve are you going to go, Seema?
So I think you can look a little bit at the belly, but further out as well. So really on the 10-year point, I wouldn't be looking at the short end for right now. We are expecting rate cuts in 2024, not this year, so that's a little bit further out. So it's really at that belly and 10-year point that we'll be adding duration.
Seema, this has been happening with a rally in the commodity market in the background as well. One question we've got coming into this week is just on retail, on earnings there. How resilient is the consumer against the backdrop of commodities starting to increase again and rates still at pretty elevated levels?
So look, they're clearly resilient today, but that doesn't mean that they're going to stay resilient going forward. So we do think the headwinds are starting to build up. You've obviously got the excess savings, which I know has been a narrative for a while, but it is now starting to come through, where the excess savings is starting to be exhausted. And by the end of this year, we do think that consumers will be having to dip into credit cards and really to pull back on spending. The other part of this is, of course, the student loans. And then, as you said, inflation, food prices, oil prices, all of these things are going to be cutting into consumer spending. It has taken a while. I would argue, I know that from other people that they believe that the lags have been very short. I would argue that the lags have actually been extra long this time. And one of the reasons is this huge amount of excess savings that has helped cushion consumers and actually to some extent corporates as well.
With that in mind, Seema, when we hear from the likes of Target, Walmart later this week, Wednesday, Thursday respectively, do you expect to hear more about trading down and less about pricing power?
I do. I think pricing power is really becoming an increasing issue. And in fact, when you start to think about how to invest, it's not necessarily about sectors or styles or anything like that. It's really about focusing on which companies do have that pricing power. As inflation continues to come down, as you get an economic slowdown, which of the companies are going to be able to withstand those kind of economic pressures? So yes, I do believe that that's going to be an increasing narrative going forward, not just this, of course, earnings season, but the next one's coming up.
So I take it you wouldn't be a buyer of this story of the equity market continuing to broaden out and to buy this cyclical play, not just in bonds, but also in stocks?
I don't buy into it. Look, I think that there is a lot of very positive investor sentiment. The soft landing has really become the consensus view. So there is going to be some broadening out. Now, how long that can be sustained, I think, is very questionable. Because, as I said, we are expecting the economic downward forces to start kicking in through Q4. Whether you want to call that recession or a slowdown, I think it's somewhere in the middle of that balance. But that will mean that things like small cap will be challenged. Now, for us, I have to say, once you start to see those challenges and once you start to see the labour market start to unwind a little bit, then that will be the best opportunity to increase your exposure to things like small cap. I don't think this is the right timing, but there will be opportunities in the coming quarter or next 2 quarters where you can start to put a lot of that money to work.
Russell down today by 0.8%. Seema, I promised a fuller quote from Neil Dutta of Renmac earlier on in the programme. I want to share it with you because it's almost a counterpoint to the kind of things that we're talking about currently. He says, I continue to see the primary risk for markets is the Fed takes its feet off the brakes too soon. You either believe a period of below potential growth is necessary to quell inflation or you don't. He says, given the inflation tailwinds from housing, motor vehicle, airplane assemblies, inventories and consumption, the US economy is nowhere near a below potential growth situation. He goes on to say and finishes with this line, the Fed continues to breathe life into the idea that rates might be cut early next year. Not good. Seema, what would you say back to that?
God, I have a huge amount of respect for Neil, and he makes some really strong points. We're somewhere in the middle there, actually. But what we're saying is that although the economy is resilient today, it's going to slow down. And we do buy into the idea that you need to have an economic slowdown if you're going to take out the five behind inflation today. But we think that's going to come down slightly down the line. So for us, the Fed stays on hold right now. You do start to see rate cuts coming through in Q1 of next year, late Q1, as some of those recessionary fears start to actually come to fruition. But I do buy into a lot of what he's saying, that look, the economy is very strong. The Fed does need to keep very, very aware and on top of that data. But to us, that means keeping rates on hold where they are rather than raising them further.